this whole idea of the follow through day. It's not just about the follow through day itself, but it's also about having that merchandise to buy. So talk a little bit about what you've learned, through your many years of trading now, and how much emphasis you put on the follow through day itself and all of these other indicators.
That's a great question. And I would say this, I look at the follow through day that we up at least X, 2%, 1.7%, whatever you want. Volume's got to be bigger between day 4 through 7, whatever. We all know that. So that's the quantitative part of the equation. We can all learn that. And once we learn it, and you'll never miss that. But the problem with the follow through day is, while they've shown up before every major bull market or uptrend in history, not every follow through day leads to a new bull market. Some fail. So the difference between the ones that fail and don't fail come down to the health and breadth of the market's leadership. That's your the qualitative side. So I think the market follow through day is just that actual follow through day that we saw. I think, what was it, a 5th-day follow through on the NASDAQ and S&P 500. Leadership was very tough to be found. I mean, my watch list was near, its low number of names for the year, and what was on there was pushing it. I mean, I think there were, I do a report once a week. I try and have, 10 focus stocks. There were times where I had 1 or 2 at the top, and that was just so I had, and it wasn't even buy these stocks. It was, this is where I would begin a watch list.
Right.
And these aren't, so we've gone from that, to a big, from the way I follow things, qualitative change in leadership, especially the breadth. We're not seeing a whole bunch of traditional leaders in that perfect spot, within 15% of, we're still very early, but there's a huge difference between what's on my watch list now and what was on my watch list. So it's that qualitative half that has to be there. So
yeah, so Russell, I'll just jump in here. It is really kind of the underneath the surface. You're seeing that strength, right? But so one thing that, and we've all gone through this, and I know I'm assuming a lot of the listeners, or a number of the listeners out there, have go through this too. When you have a few failed follow through days, right? And so we've had 4, I think, this year that have failed. How do you keep that faith, right? That you keep kind of that objectiveness. You don't let the recent history affect you. How do you keep that faith and say, you know what? It is another follow through day. Let me start, building up that watch list. Let me start taking those small positions. Even though those other 4 times I did it, and I just kept getting nicked.
I try, so I try to keep it as close to card counting as I can, like the rule. Okay. So that hot deck, I guess my hot deck rule. So we've got a follow through day, and obviously the quality of the follow through day matters when it happens, that sort of thing. But at the end of the day, if you gave me, I'd rather have a weak follow through day with leaders that are, making me want to get long before it even, like I'm telling Ray, hey Ray, we're going to follow through. I know, look at the leaders.
Right. Yeah.
We've been in those cases, and in that same fashion manner, we could have a super massive follow through day, and I go, yeah, well, we also have some of the sharpest rallies during bear markets, and if there's no stocks to buy, I'm not just going to buy something, that I normally wouldn't. I've tried it. So unless I see those canned slim style stocks, those growth stocks that I would consider on my watch list, as a follower, as a trend following trader, as a, I'm an avid follower of Bill O'Neill. I've changed it very, very little. I've changed nothing. It's my perspective on it, right? Everything I do is within that. I've just started buying early up the right side, right? So that's something that I did, or that I developed over time. And again, to help me manage risk. So back to the follow through days, I digress, right? So I have really limited. So I have to see the merchandise, like Justin was saying. And when I do, I start very, very small. I will find 2 or 3 stocks. They've got to have that optimal risk reward. I will not chase. I will not push something because I feel like, the guy over here and the guy over here is already up 14%. And oh my gosh, I've been doing everything. I don't want to, and if the stocks aren't there, if I can't manage risk optimally, there's no trade. So, and then when I do, it's going to be 2 stocks, 2 to 3%. So I'm risking no more than 6 to 9% of my capital across 2 or 3 stocks. And I wait from there. And if I get that immediate traction and the breadth noticeably continues to, grow, broaden, then it's very easy to get long fast. I force, but if all, those stocks immediately kick me out. And I think, like I was saying before, sometimes if I'm not sure, I'm like, we're still on the borderline, market's at a really iffy place, leadership's at a really iffy place, but I'm not sure. And I don't want to ignore my rule. So I will, you've got to be willing to take some risk, but I keep it very limited until the market gives me that confirmation that it's going to help me. It's going to help me when I slip. Right.
Yeah.
And to that end, I mean, there were some of these stocks that were, at least climbing up on their right-hand sides, but there's a number of these COVID plays that still look pretty awful. I mean, they might have come up a little bit off their lows, but they still look very volatile and very damaged, 80% off their highs. So how do you make a distinguishing characteristic between those that are maybe done and those that have the opportunity to come back?
So those seemed, for me, have already seen whatever that excitement, that initial push, and have fallen apart. And now after that giant decline, I just have no interest, especially given how great that overall group is and how low. I mean, they're just laggards, period. I don't even have them on my. Do you know what I mean? So there's, I guess, the newer ones. Well, it's going to come down to what, also what stage base are we in? Are we in that uptrend? I mean, for a lot of the stuff that I am looking at early off the bottom is typically newer stuff that didn't really have a chance to get going. Let's say in the beginning, a lot of them IPO'd right as the market was starting to get heavy, November, December. And, I just go back to all of the learning from Bill, where he talks about so many situations where a heavy market weighed on a really good stock. And so I'm just trying to give these newer names, especially stuff outside of biotech that has earnings and groups that are improving, that benefit, that I'm watching that in my rotation. So not only am I looking at, the ones that are proper, like the PLAB, one of the first chip stocks to break out again, KLAC, high quality institutional liquid name.
So I mean, that does make that. I think that's an interesting kind of distinct.
So there's there's those. So I'm playing both. So I'm watching those, the CDNSs or the the ones that are higher up in their pattern, and then I use that, and then I want to see what, as those get extended, where is that money going to go in the same sector or group? And it usually goes to those early. I guess it's an observation I've made. I have not done research on that. I wouldn't put it in a book, but it seems like that, right? So I want to see when the money when profit taking happens on the chips and the stuff that went out first, where is it going? And so to me, I'm watching those early up the right side off the bottom, especially if they've had that huge volume spike, somewhere near the bottom, or as they're coming up the right side. And you're right, though, a lot of them may still be 40, 50, 60% off.
But it seems like you're focusing more the right hand side on the newer merchandise. More the IPOs versus the COVID
old stuff is not
that.
Done.
Yeah. So I think that is that's a difference, right?
Yes, that is the difference. If it's not new, if it's already had its day, I'm not, so I don't care about if Datadog and all of that, the names that have had their runs in that software group. I'm not saying it's a crowd, who knows, maybe a few of those names come back, but they're going to have to show me a much more of a reason than something new or something that came out in that same area that got, pushed down while the market was heavy and it just had no chance. That's now, starting to show big accumulation up the right side. And obviously even better if it has, earnings, that sort of thing. I don't put anything on my, weekly newsletter that isn't slimmerific. I'm not, and it is that important. If you're building positions, those earnings have got to be there. If you're not seeing any earnings, a lot of these are performance enhancers. If I showed you what and I didn't do, but you want to see the kind of thing I was sad that I missed because I was so busy. HKD, through 100, and then there were a couple spots, and I just was so busy I couldn't bother watching it. But I'll see a stock like that and just talk about performance enhancers. I'll see that after the first day. I'll put that on a 3-minute chart, and as long as it's liquid and pumping, you'd be so that I do that is way outside the rules. But sometimes that so yeah, so we're at that point. I do believe we've seen there's a huge qualitative. The way leadership looks now compared to the way that it looked 3 weeks ago. 3 weeks ago, there was no way. I was still. I'm not worried now. I'm starting to sweat a little that I didn't follow my rules 2 weeks ago because I've been so busy.
Let's go back to the HKD because you're seeing this, all right? So obviously tons of speculation there, right?
Right.
Now,
right.
In the last few days, you saw a number of those meme stocks going. Does that kind of speculation concern you, or are you taking that into account that, wait a minute, it's almost like it was back in early 2021.
The pendulum swung back.
So are we back in that speculative season again?
I don't know. I guess that bothers me more. I think if we're at the end of a cycle, right, as we've already seen a bunch of stocks move, we've already made a bunch of progress. I don't know what that means as we're trying to, build the bottom and finally come up there. Like you said, we're still below the 200-day on all the averages. The one thing I pointed out, I think in my letter over the weekend, is if you look at the one that's through its declining tops line, if you start at the very high end, you finally got the Russell up through there, right? Which is encouraging. So now it's that, it's a very simple thing I want to watch. Is the NASDAQ and S&P 500 going to follow the Russell up through their lines, or are we going to have, which would be a confirmation of that divergence, or are they going to roll over and then, you get the fail? So that's something I'm watching as well. There you go, that line. So the other three haven't done it yet, Dow, NASDAQ, S&P. So I want to see a confirmation there. So that's my first. Now, I don't know. I haven't drawn the line on all of them. Maybe on one of the three, that line will finish above the 200-day. I'm not sure. But that's roughly what I'm watching. That's my next two big spots in line, that declining tops line where the Russell is taken out, and then that 200-day moving average, which you can see whatever that was there is, right on top of it.
Right. Now, let's just kind of take the step back to the big picture, macroeconomic. How much of that picture weighs into your decision making? I mean, I know there have been so many times where, if you kind of look at all of the things that could go wrong and all of the things that look ugly, you'll never invest, at the right time.
Right.
So are you looking at, any of the macroeconomic factors? I mean, again, between recessionary fears, a Fed that is, still hiking in a hiking cycle, you still have the war in Ukraine, a lot of these things that, have been concerns, they haven't gone away. So how much does that kind of factor into your decision making of that qualitative nature?
It does. Well, that all comes down to sentiment, right? So contrarian sentiment, I guess, is what we look at as slim, or, well, I mean, I guess anybody could look at it, but I guess there's some that we look at in particular that line up well on a sentiment basis, right? So I think, as we were discussing before, the news is always worst at the bottom.
Right.
And so we've seen, despite that, the crazy inflationary numbers and the Fed raising rates at a rate that at a pace that I've never seen. And like you say, the war in Ukraine hasn't ended, and all of these things were definitely what everyone was looking at as the market was, coming straight down. So I think it says a lot now that you've got the market rallying. Even 9.1 didn't shake the market. That 9.1 CPI didn't do it. The Fed raising rates at 75 and 100 basis points eclipse, not doing it. The fact that the Ukraine war is still, and we just keep on rallying, right? We've had most of the S&P 500 report now, earnings season, so most of that's out of the way. So, did we speak about this earlier in the show? I had one of a close friend of mine who's in the market call me up, a bit panicked yesterday over news, and I'm like, perfect, right? That's exactly what we want to. So the wall of worry, I think, is I'm looking at that as a wall of worry now. So now, as I watch negative news come out and the market really unfazed, I love seeing that. Yeah. So, we haven't even seen it start to get good at, the news become positive as the market's going higher, which I guess eventually happens if the uptrend continues, right? So, but right now the stocks are telling you that it's looking forward past all of that. I don't know what it's looking at. I mean, the fact that the builders, you know, which are pretty sensitive to interest rates, like I said, it's amazing. Those are going up with, you know, Goldman Sachs and Bank of America, which at the same, you know, those you would expect to go up on rising interest rates. The builders, not so much, right? So.
Yeah, it's funny how sometimes, you know, you see the technical action and then you find out the why so much later.
The why is always later. So that's why that whole watch the leaders. Yeah. So you want to know if the market's going to retake the 200-day moving average, watch the leaders, right? So yeah. I mean, really, that if the leaders lead the indexes, not the other way around.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.